Good morning, everybody. Welcome to Coffee and Property episode 4 from Cornerstone Tax. And this morning, as you're all aware, we have James Hadley with us. He's going to tell us all about property from pensions. And so grab your coffee, sit back, let's have a listen. So James, come on. One of the first topics that you said you wanted to discuss was how pensions can solve Britain's social housing problem. How is that going to be achieved?
Well, it's going to take a lot of hard work, but I think that there's a tremendous opportunity here not to be missed. And I'm certainly no expert in social housing, but some of my clients and good contacts are, and they're very active in the space. And some of the numbers that I hear, are frightening. That we've got over 1 million people on the waiting list for social housing, and there was less than 7,000 social homes built in 2020. So, there's a massive problem there. But then I look at it from my position of being a pensions professional, that there's nearly £3 trillion in pension funds in the UK, that an element of could be diverted towards solving that problem.
Mm-hmm.
And so to me, it seems almost like a wasted resource, because if you delve a little bit further into this and you think, okay, so what would be the case for more social housing investment from pensions? Well, in terms of pensions and what that offers to the social housing market is it's long-term patient capital. It's not speculative. It's not here today, gone tomorrow. It's going to be, multiple decades that money is there.
Over £2 billion a year is overpaid on stamp duty, with up to a quarter of purchasers paying the wrong amount. From millionaire developers to residential homeowners, anyone may be affected by these errors. Contact us today to see if you have overpaid your stamp duty and owed a refund from HMRC.
Which means that it can slowly and gently drive up standards in the sector for the consumer ultimately. But then you look, okay, so what's in it for the government? Well, it solves a social housing issue. That's a big one, and presumably a vote winner. But then you've got the wider issues of, you hear things about pensioner poverty. That's been on the rise for years. And the current inflation spike that we've got as well is just perpetuating that problem. But however, if you've got long-term returns from property that are ultimately being funded by the government anyway, you're solving the pensioner poverty crisis. You've got wealthier pensioners. Wealthier pensioners are healthier pensioners, which means they're less burdensome on the already crippled NHS. We tax them more because the pension payments are income taxable, and they're also spending money, so they're paying VAT. So this money that at the moment there's potentially a bit of a leakage, if you like, and there's definitely a shortfall, where actually we could recycle the same money, but improve the outcome for multiple different stakeholders.
And I mean, until I spoke to you a few weeks ago, I was genuinely under the impression that pensions could not invest in residential property, but you're obviously going to tell me that I'm wrong. Well, I now know that I'm wrong, but for the benefit of the audience, can pensions invest in this sector?
Yeah, they can. And, I'd always be very careful to tell you you're wrong on telling a chartered tax advisor they're wrong. But I think it's to do with niches, isn't it? Because, you've been a specialist of focusing on SDLT since SDLT was introduced.
Yeah.
And similarly, I've been in pensions since before the Finance Act 2004 was enacted as well. So I've seen the consultations.
Oh, you were doing it at junior school then, were you?
That's very kind of you. Thank you very much. My sister-in-law was into aesthetics. Moving swiftly on. Look, we've seen these things evolve, and for anyone that is a pensions historian, they might remember back to the proposals for pension simplification when they were announced back in the early noughties. There was all sorts of talk of, pensions are going to be allowed to invest in buy-to-let property. And working for the life officers at the time, we saw a mass influx of fresh capital. People said, great, well, I hate shocks and scares, but I love bricks and mortar. And so if I'm going to be able to get the tax advantages of a pension and use and invest in property, I'm all over that. Money came in. Subsequently, there was a U-turn, but the U-turn wasn't quite what people thought. So the initial proposals were that an investment regulated pension scheme, we've got to be very specific, is only investment regulated pension schemes, which in English are SIPs and SASs. The proposal was to allow them to invest directly into residential property in the same way as you can commercial property. And that was scrapped. And the reasons for it being scrapped is Gordon Brown was very concerned about people using tax relief money to buy second homes in Saint-Tropez. Labour Chancellor found the prospect quite offensive. But what people didn't really get their head around is when the legislation was introduced, there's a specific part of Schedule 29A that deals with indirect investment in taxable property. Now, for the purposes of what we're talking about, taxable property is residential property. And to distill it down into its rawest form, it states that if a pension scheme invests into taxable property indirectly through one of three types of vehicle that the legislation describes, the property is no longer taxable, i.e. there's no penal tax charges. So those three structures are: one, trading concerns. The easiest example of a trading concern is probably a listed house builder, Persimmon, Taylor Wimpey. It would be pretty ridiculous if you've got all of the FTSE 100 trackers that most of people's pension funds are invested in. Suddenly people were getting unauthorized payment charges because there's exposure to property. So if you invest into residential property through a trading concern, there's an exemption. Similarly for real estate investment trusts, because again, there's some massive real estate investment trusts in the FTSE 100, British Land, Seagrow, etc. If an investment regulated pension scheme buys shares in a REIT and that REIT then invests in residential property, again, there's an exemption. But then there's like a bit of a catch-all, and HMRC, they describe these things as other kinds of vehicle, which I'm sure you'll appreciate as a tax practitioner, that's disconcertingly vague. But these are the kinds of vehicles, they're not specified as to what they are, but it's the characteristics of what they are and what they are and how they run. And so, I mean, most people have heard of an investment vehicle, if they're old enough, called a unit trust. I mean, in the 80s and 90s, people used to send out brochures of them. You know, you get them at the weekend, tick the one you want, send your check off. I think Hargreaves Lansdown started that way. But unit trusts can be set up as authorized unit trusts that have got billions in them. And you can set them up on a private or a semi-private basis, where actually you've got a professional trustee, you've got a manager, but then you've ultimately got the underlying investors as their own fund manager. Now, these unit trusts can be structured correctly so that they fall into the regime that HMRC describe as genuinely diverse commercial vehicles, and therefore don't fall foul of the taxable policy.
Don't fall foul. I mean, again, from my personal experience, you know, if you were to go to a SIP trustee or somebody like that and go, right, we're going to put something into residential property, they practically reach for the crucifix and the garlic. You know, they're like, no, you can't do that. And it was a shock. I mean, I said genuinely for the benefit of the audience. I mean, James and I were talking about this on the phone. Literally, I think it was about a month ago. I was just like, really, you can do that? I mean, just for the benefit of the people listening, I mean, one of the other topics you said was becoming a banker to your own business. Why any of us would want to be called a banker, I have no idea. But nevertheless, let's talk about that aspect of pensions as well. How does that work?
Well, I think it's an interesting point that you made, and yeah, perhaps people wouldn't necessarily want to be described as a banker, but they wouldn't mind earning the type of money that people perceive that bankers earn, which I think is one of the reasons that bankers get stick, or just one of the reasons bankers get stick. But this whole becoming a banker to your own business idea, I was first introduced to it formally probably back in 2010. And there was an American financial advisor, he's dead now, his name was Nelson Nash. And he had some really remarkable, revolutionary ideas about personal finance, because this guy was a career changer. He wasn't a lifetime finance professional. He was actually a forester. He trained in forestry and managing, however many thousand hectares of forestry in the American Midwest or whatever. And when he had his career change, he naturally brought some of his world from being a forester and how to grow, nurture, and maintain forests. He brought that into financial services, and he was influenced by Austrian economics and all sorts of stuff. But he just figured out that if you look at the amount of leakage we have in terms of what we pay to finance houses in all parts of our life, credit cards, mortgages, personal loans, car loans, leasing, tuition fees, whatever that is. And then we also look at the opportunity cost of that money not being invested into something, because you're losing that interest and then you're paying it to someone else. He effectively preaches creating almost like your own banking infrastructure. And anyone that wants the book, drop us a note and I'll send it to you. I've got it on PDF. Right. Very short, very to the point.
But that's slightly wider than the conventional assumption that, say, with a SaaS, you can make a cash contribution to a SaaS and then lend it back to your own company. You're talking about something actually conceivably much wider than that, aren't you?
Yeah, the thing is, and that's where it led me to, which was, okay, I read Nelson Nash's book, I understood it, 100% behind the facts in it. But of course, the financial product infrastructure in the US is different to ours. There are similarities, of course, because the similarities to the legal system to a degree. But there wasn't a corresponding product here that could do what could be done there. But then, I'm very slow on the uptake with some things, and I just thought to myself, well, actually, we've got an even better product here that gets upfront tax relief, and it's a pension scheme. And even though the loans out of it are, at the time, I assume that the loans are capped at 50%, the tax relief on the way in is a real sweetener. And so, again, both investment regulated pension schemes, SIPs or SASs, can make loans. There are rules, more stringent rules about making loans to connected parties. But if you take a standard business and you look at the long-term effect of effectively, let's say, refinancing an overdraft, a metal basher in Dudley, £100,000 overdraft, let's say, of course there's a personal guarantee on it because that's what banks do. It's probably a relatively high amount of interest, leakage. Yes, that interest is tax deductible, but once it's gone, it's lost. By making pension contributions, and an awful lot of people have got them from previous employments. Historically, people didn't necessarily leave school and start businesses. I know that happens more now, but people did 10, 20 years in employment. They got a pension of sorts, perhaps. If you restructure that in such a way, and so you restructure your overdraft so it's with your own pension scheme, you're getting contributions into your pension scheme that don't count towards your annual allowance, and suddenly you haven't got some credit committee squeezing your balls every quarter saying, where are your management accounts, waving your PG at you, putting you into special measures, all this shit. You've got a more rational lender, let's say, because HMRC do impose quite strict requirements on what the terms of the loan can be. They are strict, but they're not particularly onerous. There's only really 5 key strands to it, and as long as you can tick that box, you're away.
So I'm assuming one of those is that you have to pay the pension scheme market rate of interest on any sums borrowed.
Yeah, literally, it's not that much over base. You're talking about 1 over base. It's an average of high street banks rates. You've got to pay capital and interest over the 5 years equally, so it's got to be equal instalments per annum. There has to be security, but again, there's an awful lot of misinformation out there. People over the last 5 years particularly think they don't need to seek specialist advice for things. They just think they can go straight to a SaaS provider and they're going to get advice, and they're not. So they come back. Just this morning I saw a guy, oh, well, I can't get a loan back because I haven't got an unencumbered property. All of my properties have got mortgages. Well, you know, if you are of the mindset that the word security means unencumbered residential property, it's your own fault. Security, the security needs to be in favour of the pension scheme in the first charge. HMRC don't specify what that security is. I mean, I've seen intellectual property used as security. Now, if I were making the loan, I wouldn't allow intellectual property to be used as security, but it ticks HMRC's box, and that's just not one case. I've seen dozens of them.
So, for example, again, you know, with my accountant head on, so a general charge, a general debenture over the assets of a company would be security for these purposes.
We've seen debentures, a pledge of shares, even. I mean, you have to take I mean, like yourself, my practice is in property, so you have to be very careful with the loan documentation, particularly the security documentation, that you don't take an indirect interest in residential property, because that in itself, even just setting up the loan without taking possession of it, can create an unauthorized payment charge.
Yeah.
But as long as that is carefully navigated, there's no reason to avoid it.
Okay. Well, it's interesting, and we'll come back to that in the wrap up at the end. And just to give a break for a second, Roger Tate has put a question up. He says the audio's not great. Will a recording be available? Yes, everybody, a recording of this will be available later. And indeed, we will be putting this episode and excerpts from this episode onto YouTube over the course of the next 2 or 3 weeks. So if there's a particular section of the webinar that you want to hear again, or maybe you don't want to hear again, then you don't have to go and click on that one on YouTube. Now, developing property, how to use your pension scheme to develop property. This was another topic we chatted briefly about, and I thought was worthwhile people hearing about.
Yeah, well, again, this is something that there's been opportunities to do this in the legislation for years. It's just that it's not an area that anyone else really practices in, and there are reasons for that. There are quite clear reasons for that. But the key aspect of this, using a pension scheme to develop property, the first decision that has to be made is: are you trying to develop it in the scheme or outside the scheme?
Mm-hmm.
Because if you're trying to develop it outside the scheme, okay, you could use the pension scheme to finance another vehicle to do it, but you're potentially creating another big tax problem. And you've also got the same issue of, if it's residential property, at some point there's going to need to be a restructure of the assets, because they will become residential, and you've got the same issues that we've already kind of covered. If you're doing it inside the pension scheme, the issue is that pension schemes are not trading vehicles, they are investment vehicles, and people, you know, non-tax people don't always get it. The property development is a trade, it's not and so it would be pretty ridiculous if HMRC create these lovely tax-free wrappers. We've got pension schemes that don't pay any tax, and suddenly they're used for a trading purpose, and there's a complete evaporation of tax take for the Treasury. So HMRC will seek to withdraw the tax advantages of a pension scheme that's deemed to be trading. However, they specifically consulted on the taxation of unit trusts in 2012, and then on the back of that consultation, they changed the legislation as well. And so, if you're using a type of unauthorised unit trust, correctly drafted, and the pension scheme invests in the unit trust, and the unit trust is engaged in trading, that unit trust specifically converts trading income of the development into investment income,
to investment return. Yeah, which is I can kind of get it.
Yeah, so and that's specifically in the legislation. There's no fudge, there's no loophole. It's not that the legislation didn't say we can't do it, so therefore we can. It's there, and it's there deliberately, because in HMRC's own consultation, they raised it and said they wanted to leave it. So it's actually a very, dare I say, it's quite a safe area for clients. HMRC do make U-turns, choice case being one of them, but actually having it spelled out in the legislation that you can do it is a better starting point than, oh, well, I read it on Facebook that a mate did it and he didn't get caught, which I read all day, every day.
I mean, to what extent do you think the latent, and I'll call it latent conservatism of the pensions industry and pension trustees in particular, and we've covered a whole gamut of things so far in this conversation, the fact that we've got trillions sitting idle that could be used to fund social housing, which is permissible, how you could do development, how you could use money carefully drafted to fund your own business. But how much do you think the latent conservatism of pension trustees has actually created that issue in the sense of this vast pool of underinvested capital?
Oh, it's massive, and you've also got regulatory squeeze as well. I mean, I love to unpack this because people ask me all the time, why haven't I heard of it? Why doesn't anyone do it? Well, first and foremost, I can tell you, having started my career in pensions on the provider side, property is a pain in the arse, and providers view it as a pain in the arse. And their pricing structures are actually dictated to try and get people to not do it in the first place. Because if you look at where we are now, it was perhaps a little bit different 20, 30 years ago, but if you've got a small self-administered scheme that you are a professional trustee of, if you want to trade shocks and scares, or your client does, well, you just set up an account with the likes of AJ Bell, you restrict the dealing permissions, and you say crack on to the client. You know, they'll buy Vodafone, they'll sell BP, they'll do what they want to do. And there's a live feed of the values and the trading and the charges, and it just pumps through into their system. Client logs in, they get the value, hunky-dory, great. You know, get my grand a year to administer the thing like clockwork. Okay. But when you've got property, we haven't got that yet. I'm hopeful that the blockchain actually will sort that out. That's a whole different conversation, and it probably makes out I know what I'm talking about, and I don't. But hopefully the blockchain will fix that. But you know, you've got property, you've got solicitors, you've got land registry. There's all the other bits and pieces. There's a conveyance process. You've got administrators that necessarily don't do it all day, every day, and they're pensions administrators. They're not conveyancers. You've got all of the parties, you've got agents chasing the trustees saying, why haven't you completed? My client's going to pull this and all this shit. They really don't want it. And there is no provider that I've ever come across that consistently delivers in the property space. There are some that are better than the bad bunch, but
I mean, you know, as somebody whose offices are in his SIP, I can 100% agree with you on that statement. I'm not going to get into my personal details, but suffice it to say the situation is less than entirely satisfactory. The reason I mention this is that, as you know, we've been working in this area, and particularly in the area of stamp duty and selling property from companies and properties from partnerships into pensions. And the fact that the pension trustees and the solicitors acting for the pension providers have been paying SDLT when they shouldn't have been. And the fact that we've now, I think we're up to about 70 refunds, but we're still getting a lot of resistance from the pensions industry saying, oh no, well, are you sure that's right? Are you sure the revenue won't change their mind? I always find it interesting that when you've got an industry, particularly at the forefront of going, make sure you've maximised your tax release, make sure you've maximised your contributions, make sure you've done this. Oh, but hang on a minute, pay stamp duty when you shouldn't, when we buy a property. I'm having trouble reconciling the two attitudes. Is it, do you think, a lack of information, or is it willful ignorance that they don't want to go there because they don't necessarily want to upset HMRC, believing that it would upset HMRC when in fact it doesn't?
Yeah, there's a whole there are numerous aspects to this. Covered some of them. They don't like property. Also, you got to think that pension trusteeship, especially for small self-administered schemes, it's a bit of a jack of all trades role. You've got to be able to understand all sorts of things, you know, trust law, pensions, tax, accounting. You never really know quite what's going to get thrown at you. But I think well, who does like admitting they're wrong in the first place?
Well, very true.
I think you know, I mean, this is going to say it's easy for me to say sat here and perhaps a little bit aggressive, but I think I think once the prospect of litigation starts to arise for negligence, once it's been brought to their attention, or if that arises, it will narrow their mind. And I'd love to see someone that's got a beef throw some cash at it, because and that's just my take. I think sometimes there needs to be something that makes people sit up and take notice. And I'm certainly banging the drum with people saying, okay, well, you've said to your financial advisor that you want to invest in property. Why haven't you taken them to task about why they haven't investigated genuinely diverse commercial vehicles as a means to do that? It's no defense to say I didn't know in a regulated profession. If they didn't know, they should say they don't know, not just ignore it. But IFAs, all they really want is funds on a platform, funds under management, shocks and scares, sell it for 5 times trail at the end. They don't want anything that's a little bit out of the ordinary, and that's wrong.
Well, I would have thought, as a professional, open-mindedness, a willingness to at least receive an idea and discuss it and debate it intelligently is I describe that as a sine qua non of advice. You listen to your clients, you understand what they're talking about, and if you don't know, you say that the most honest answer you can give as a professional is, I'm sorry, I don't know the answer to that one, but let me get back to you. But too often you hear people go, no, you can't do that. And pretty much what you said at the start of this discussion. Oh yes, no, I heard somebody mention that in a conversation at a conference I went to, and they told me it was illegal. Well, did they tell you why it was illegal? Well, no, but obviously it must be if they said it. And it's just like, no. We've had this, we've been presenting in the House of Lords at the behest of Baroness Altman on this issue. We've done it twice now. We're about to go for a third dip, and still we're not getting people going, yes, we do have a problem here. It may be that they don't want to admit fault. You're quite right. They don't want to look stupid. I really don't know. But the honest thing to do would be to go, yeah, hang on, yeah, there's an issue here. We need to think about it. And would you come and tell us about it in detail and work with us on it? But it's a strange. I find the pensions industry at every level, from client sales right the way through to actuaries, to be, I describe it as almost blinkered and hidebound to a degree that they cannot accept new thinking. I mean, is that a perception that you have?
Yeah, I think so. And it isn't necessarily just the pensions industry. I think it's another piece. It's people in professional roles. In professional firms, risk and the management of risk is the number one thing on the agenda. And it seems that the bigger a firm becomes, the more concerned they are with risk.
Yes.
And because risk.
But is that risk to their clients or risk to themselves?
Well, that's going to be that's down to their viewpoint, isn't it? I see business risk as perhaps quite differently, I think, but they will perhaps see risk of litigation, complaint, risk of finance. What about the risk of winning? What about going back to your clients and saying, you know what, we've gone back and revisited all our book, and we realise that you've overpaid, so we're initiating refund proceedings because we think that's the right thing to do. And the client thinks, you know what wonderful people my pension trustees are. They've realised that there's a shift in their knowledge. They've identified a problem and they've come to me with an avenue to resolve it. I can't ask for any more.
I think this is the argument we've been having for a long time, is to say, we call it white hat, black hat, grey hat. The white hat guys are the guys who are alive to it and initiate it before there's a problem. Yeah. The grey hat guys who go, guys, we just looked into this, we realised there might have been a problem with something a few years ago, but we're going to work to fix it. The black hat guys, it's always an allusion to cowboy movies, by the way, for those of you who aren't of my generation. And the bad guys always wore black hats. The black hat guys are the guys who go, no, I'm not I'm not listening, I don't want to know, at the very least. Or who go, and I've regrettably, I've had this attitude, and not from a small provider. I'm shrugging the shoulders and going, it's not our problem. Well, it is your problem. You're the trustee. You have a fiduciary duty to maintain the capital of the fund. You've allowed that capital to be wasted.
Yeah.
Therefore, you're liable. And on that subject, more news in a couple of months, folks, because somebody may be about to get sued on that one. Just moving slightly away from the tax and the stamp duty for a second, but you know, like you could probably bore me for hours on technical aspects of pensions. I could probably bore the entire audience technical aspects of SDLT, pensions, trusts, and other connected parties. It's one of my favourite subjects, as you know. Just to summarise where we've spoken today, you know, we only need to unlock this capital. What do you think? What's the future of pensions in relation to property in this country? Do you think we're going to see a shift via generally diversified commercial vehicles, GDCVs? Are we going to see a shift into social housing? Are we going to see a shift into buy-to-let housing generally? Because surely the way to solve the social housing crisis is to increase private rental stock, whether it's pension funded or not, to make those rooms and those apartments available to the people who desperately need them. But at the same time, we've got a government whose taxing policy, certainly as far as stamp duty is concerned, is to penalise the private rental sector. Yeah. I'm, to use the phrase, hearing mixed messages, and I've been railing about this ever since 2016. I said, well, why would you want to deter private renters, the private rental sector landlords, at a time when we need that stock? And I think because of the pandemic and the shortfall in construction, it's now actually exacerbated the situation even more.
Yeah, I think, you know, I'm sat here pro pensions and pro property as an asset class for them, but that's just the micro niche in which I find myself. If there's one of the things that I do have concern about in the property market, and some of the people I come across, is that they do become rather one-eyed about property. And I know how it happens. I know why it happens. I do think that I know that there is a growth in property investment in property just from the deluge of inquiries we get on a daily basis. So it's actually more an awareness thing at the moment. And, you know, we know how many genuinely diverse commercial vehicles were registered with HMRC. And we're frequently checking in with them to check our own growth, because we know that the growth in the sector is coming from us and not really anywhere else. I think diversification is a good thing. I think that there needs to be some other asset classes within pensions as well, for liquidity, for diversification, all sorts of good stuff, because property is a lumpy asset. You know, you can't typically just call up a broker and say, you know, can you liquidate that because I've got a bill to pay or something. The best you can do, really, I guess, unless you've got someone who will just buy it, you can whack it in an auction, but that's still going to take some time. So I do think some diversification is a good idea. On the social side of things, I think that the limiting factor is probably access to the deals. Because again, there are people out there that are, I guess, peddling social housing, supporting living as a sector, and they're selling courses, or they've got properties that they're sourcing in this sector, and all that glitters isn't gold. So I'm not trying to say that everyone should suddenly ditch equities and go and try and put it in social housing, because that creates another even bigger problem. People start losing the shirts off their back. But I'm saying, in a controlled way, if there is a decent framework that's rolled out to allow people to migrate some of their pension scheme from where it is now and into social housing, that will have benefits for all stakeholders, undoubtedly.
And I would agree. I mean, I'm a businessman, you're a businessman, and to me, having a vast pool and stagnant pool of capital sitting in Britain's pension funds, which could be used to improve our society and our economy, as you very adroitly pointed out, it's a virtuous circle. You know, if you get pensioners who aren't in poverty, their health improves, they therefore aren't likely to need social housing or further dependence on the state. And actually, we bootstrap the whole thing up, and I'm fully down with that. I get that, absolutely get that. It's just interesting because, you know, you look at this, you look at the figures for private rental sector rents at the moment. You know, we've got an undersupply in the PRS generally, never mind social. Rents are rising faster than inflation. Property prices are rising faster than inflation, brackets just at the moment. But my view, and I don't know what the view is, the view of the audience is, or your own, but my view is that this inflation spike at 9%, we're going to start to see that sliding back. Whereas I believe that property price growth and rental growth is going to remain at or around 9%. We have to recognise that with interest rates at, what are they now, 3%? You know, in real terms, the short-run interest rate is actually negative. And actually, the economic logic in that is, well, when if you're locked into a 5-10 year trend like that, then you go and borrow a load of money because you know that your asset base is going to basically track inflation or beat inflation, but your debt is actually going to devalue over time. That's you know, sort of economics 101 from those of us who grew up in the 70s and 80s. You know, it was like, well, that's what you do. You know, I can remember buying my first house. I think I paid 45,000 for it in the early 1980s, borrowed 30,000 because that's what you did, because you got mortgage relief on it in those days. By the time it came to sell it 3 years later, it was worth 87,000, nearly doubled in price. But my mortgage was still only 30. So I walked off with 57,000 out of my original 15,000 investment. Not a bad return. And that was how you played the property game in those days. But I think it's the trouble is with the fundamental, I'll call them economic and geopolitical instabilities at the moment. Nobody's willing to probably to put their hand up and go, I think it's going to be this in 5 years' time. I don't think anybody's willing to do that for 6 months at the moment. I mean, you know, what are your views?
What I'm seeing at the moment, I guess I'm not going to answer your question directly, and that's because I'm a very simple man trying to stick to the very simple issues. But what I'm seeing at the moment more and more is not everyone, but there's quite a lot of people who are almost just, they feel paralyzed by the conditions because, you know, inflation and cost of living sort of stuff. And it's almost that people are struggling to make a decision based on constantly changing variables. Mm-hmm. And that actually, if they could cut through some of that noise and just take action and not procrastinate, they'd probably benefit from the conditions at the moment. But I appreciate that's difficult to do at times.
No, and I accept that. I think it is fascinating that, ironically, as you say, people should act quickly in these times, but the very nature of, I'll call it the media, the mainstream broadcast media and everything else, are actually promoting uncertainty rather than saying, you know, you would never find somebody coming on Channel 4 News and saying, right, ladies and gentlemen, Russia's invaded the Ukraine, grain prices have gone through the roof, the oil price has gone up. Now's a great time for you to invest. You're never going to see that as a headline. And it may or may not be right, I think, but yeah, I rail against decision paralysis, as I call it, or analysis paralysis as well, which is often people will overthink things rather than, you know, we're probably straying completely out of this field, and maybe we ought to have a discussion about this in a separate episode. Is gut investment better than technical analysis? But that's probably one for we'll probably have a stockbroker versus chimpanzee with a dartboard, and we've all seen that comparison. The chimpanzees actually made better investment decisions based on a random dart throwing. There's a lot of fun in that. Just going to, before we wind this up, and you know, first of all, James, thank you for coming on. It's been absolutely fascinating. We had one question, which was from Will Mallard, which he was asking, what are the specific different structures available for self-directed pensions to invest in social housing, and some pros and cons of them?
Okay. So I guess it depends on whether you're wanting to manage the money yourself or not. I have to take a step back and not be assumptive. So if you're a passive investor and you want to get into social housing, there are specific real estate investment trusts that do so. You've got Triple Point, you've got Civitas. What are the advantages? Liquidity, professional management. They'll have access to certain deals that a lot of the people wouldn't due to their size and scale. What are the downsides? Well, actually, they're probably taking the biggest bite out of the returns. So, you're looking at, I've not looked recently, but you're looking at a dividend yield of maybe 5%, 4s, 5s. So it's not massively attractive. You're not getting the benefit of the leverage. If you wanted to manage it yourself, you can either set up a private REIT, which is possible, has been possible since Corporation Tax Act 2010. You can set up a private real estate investment trust. Pros and cons. It costs to set up. It costs to run it. What are the advantages of it? Well, it can borrow at market rates. So if you can get a 75% loan to value mortgage for a limited company, guess what? You can for a REIT. It can have more than one class of share, which are good for tax planning. Pension scheme can own one. Another entity can own one, or not. Good for co-investment. So REITs are kind of like the Rolls Royce. For something that's a little bit more or less sophisticated, you can use a variation on a unit trust structure, whereby effectively you can create an interest under an existing structure managed by whoever you appoint, including yourself. The advantages of that are that you can get leverage. I guess when you compare it side by side to something like a REIT, it has only one class of units, so the income comes and lands back into the pension scheme. But those are the two main things. The other exemption that I mentioned earlier for trading concerns, you can invest via a trading concern, but you're losing control. And most people that I deal with are independently minded, and the idea of losing control freaks them out. So we don't even talk about it.
Okay, that's fantastic. Listen, thanks very much for coming on today. I've genuinely found this, informative and fascinating, and I have no doubt that you and I will be presenting another one of these episodes soon. We'll have to, if anybody in the audience has got a suggested topic that you think James and I might be able to spar on over the course of 30 minutes, do let us know. It's been absolutely fascinating to hear you. Thank you, everybody, for listening. Thank you again to James. I'm David Hanna. I'm from Cornerstone. We're stamp duty specialist. If you want to know about property from pensions, though, go see James Hadley. Thank you once again, everybody. See you soon.
David, thanks all.